Hello and welcome to BQ Prime. India's inflation print for May came in at a 25-month low. The retail inflation stood at 4.25% in May, compared with 4.7% in April. That's even lower than expected. To give us her insights on today's print, we're joined by Yuvika Singhal from Quantico Research. Yuvika, thank you so much for taking time out.
My pleasure, Pallavi.
Today's inflation print is a tad bit even better than expected. However, on a sequential basis, we did see some items in the food category seeing a little bit of an uptick, while some others saw a downtick. So what are your first thoughts? What have you made of today's figures?
I think on a headline number, we are pretty much in line where our expectations were pegged. We were slightly above 4.31. The number has come in at 4 quarter, as you rightly said. So not a big surprise on that front. Even in internals, if I look at the granularity of the subcomponents, I do find that there is some momentum in food and fuel. If I deep dive into fuel, so if you remember last 4-5 months, we had barely seen the fuel index change. This time around, there is some buildup of momentum because of possibly some electricity-related tariff revisions that we saw at the state level. Within food, it was a very mixed picture. So overall, if I look at the food momentum, it's fairly subdued, given the typical seasonality with the onset of summer that we see. And that's largely because on one hand, while we have seen prices of perishables and within perishables, milk and vegetables continue to increase with the onset of summer, we also have pockets of comfort coming in from disinflation that we've seen in items such as cereals and oilseeds for the last few months. So overall, food per se, like I said, is a mixed bag. I think the good news is more on the non-food, non-fuel side of inflation, which is what we typically call core inflation. And there we see a downgrade in momentum across all major categories. And there is a comfort building up there as far as the core headline inflation is concerned. So if you look at core inflation by the RBI metric, it's somewhere around close to 5%, and it has continued to decline systematically over the last few months. And even if you look at a more nuanced version of what we call core inflation, which strips off not just food, fuel, but also petrol, diesel, gold, a few other items which are typically non-demand oriented, or we are price takers for these. And if we look at this metric of core inflation, there also we see a decisive correction in the headline core inflation, somewhere close to about 540 levels, higher than the RBI metric, but it's a systematic correction on the core side of inflation, where I think the comfort should be drawn from not just the headline, but also core, which is beginning to shape up on a lower trajectory.
All right, sure. So while that's definitely a source of comfort, I do want to understand what are your expectations for the inflation trajectory here on. So even in the Monetary Policy Committee meeting we saw last week, while the RBI revised its inflation forecasts for Q1 and a little bit by Q2, Q3 and Q4 forecasts were kept as it is. So does that mean that today's print is a bit of a temporary respite and headwinds continue as we go forward? Like, what's your take on all of it?
So we would probably view this particular May inflation print as probably a point of local minima. And what I essentially mean by local minima is that it's probably the trough of this inflation downside that we are seeing in numbers. Having said so, so we have to keep in mind that the correction that we have seen over the last 3 months on the inflation front, while there has been a slowdown in momentum, in large part has also been driven by a favorable base, which is going to wane in subsequent readings much more quickly, also as we move into the second half of this fiscal year. So to us, this is a point of trough. Here on, we see inflation readings subsequently moving up. The comfort would remain probably more in the first half, like I said. Second half readings will move even higher. But if I were to put it into a band, we see subsequent inflation readings largely in the band of 4.5% to 5.5%. And what this means is that for year as a whole, inflation is likely to be above 5%. RBI, like we know, is at 5.1. Our own estimate is 5.3. While we do see a larger than expected downward momentum, probably, if we compare our own estimates to 3 months prior, we do find the last 3 months of inflation reading definitely have given a higher than expected comfort. And looking at where crude prices are, and, in a very range, $70 to $80 kind of a band that they've moved, we did feel that there is some possibility of a downside to our 5.3 inflation headline forecast for FY24. But we have held on. We have not, gone and revised that number lower, largely because we feel that there's a very strong risk that comes in from what happens on the El Nino front. As we know, the global agencies have now marked the onset of El Nino in a decisive way. And whether it hits in what kind of a timeline, whether it's July or August, will make a material impact on India's monsoon performance and thereby some food price pressures that we'll see it. So the good or a positive development would be that if El Nino develops somewhat late in the season, August or thereafter, we could still see a fair degree or a fair chance of headline monsoon performance being close to normal as IMD pegs. But if El Nino was to come in a much stronger intensity and hit us sooner, sometime in the month of July, with the Indian Ocean dipole, which is somewhat like a counter to El Nino not being able to strengthen up till July, then probably we are looking at a worst case scenario where El Nino hits us quicker than expected and IOD is not able to counter it. And in that situation, we could probably see some impact on monsoon performance, Kharif sowing, and thereby probably some expectations as far as commodity prices and food prices, building into the inflation forecast. So for now, we have still holding on to a 5.3. But like I said, for this year, the inflation band is probably going to, in subsequent inflation readings are probably going to be 4.5 to 5.5. The story or the RBI's desirability of moving to a 4% that is the midpoint of the inflation target band, I think it's a story which will play out next year. And it's only next year that we could see inflation move step down lower to the handle of somewhere around 4.5. But again, it's a long shot, a year away from now. Too many moving parts on both geopolitics, monsoon. It's very difficult to hazard, an outlook as long ahead as 12 months. But if it was to happen, it would only happen next year, and that's gives credence to our view that RBI is in for a long pause or a prolonged pause continuing through this fiscal year. So we are calling for no rate cuts in FY24. And if rate cuts, if the room was to open up, would only happen in Q1 of FY25. So that's essentially what we are thinking in terms of both inflation and RBI's reaction to the inflation trajectory.
All right. So, to get this right, this year, like at the last meeting, we did see Governor Das emphasize that while inflation has fallen within the target range, it has not hit the target of 4%. And going by your expectations and the RBI's own forecasts, is it fair to say that this cycle we do not see the RBI, like the inflation target of the RBI being met? And while there is an expectation of a long pause, as you said, as and when there is a reversal, be it early next year or early next fiscal, that will be without inflation actually having touched the 4% target?
So absolutely, Pallavi, at least for the foreseeable, this fiscal year's inflation timeline, we don't see inflation coming at 4%. Like I said, the May reading is probably the trough or the local minima that we have seen, and subsequent readings will be higher. Now to answer whether 1 year hence, so we know RBI's own Q4 inflation forecast, that is Q4 of FY24, and it sits well above 5% at 5.2%. Now, what we have to understand that there are too many moving parts of inflation, and probably if we were to move in the second half of the year towards what we see on an annualized basis, from FY23 to FY24, there have been decisive shifts in inflation. So compared to a 6.7% last year in FY23, we are now talking about somewhere close to about 5.3 kind of a range. So there is a correction in inflation, sure, right? So there are demand and supply side impulses which are giving way to a softer number. And if these correction in demand and supply impulses were to continue by the end of the year, because we know that growth is going to slow down. So we are looking at, say, from a close to about 7.2%, we are looking at 120 basis points of slowdown in growth as per our own estimates. So our FY24 GDP growth number is pegged at 6%. So there is bound to be some correction in demand. We know that supply side bottlenecks are also giving way in a much more faster way. Supply chain bottlenecks have gone away to pre-war levels. So I think this momentum of correction on both in demand and supply side forces of inflation is likely to continue towards by the end of FY24. And when we have that decisive foresight of inflation continuing to correct well into FY25 and moving on to a lower handle of say between 4 and 4.5, I think yes, RBI could be more preemptive rather than reactive in terms of its rate cutting cycle, because they would have sat on a prolonged pause. And probably that would also coincide with what the key central banks globally would probably be doing at that point in time. And a rate cutting cycle or a pivot there would also probably be taking shape in early part of next calendar year. So I think all these factors will coincide. The comfort on inflation, even if it doesn't hit 4% by the end of 24, but the comfort on the foresight or the timeline of it and what is happening globally could probably see RBI moving somewhere around the first quarter of FY25 to a rate cutting pivot, if I could say so.
Got it. All right. So, moving on, we saw figures for industrial output today as well. Industrial output grew 4.2% in April. Even that was better than expected. However, on a sequential basis, performance was a little disappointing. What is that indicative of? And also, what is your reading at this stage of other high frequency indicators in the state of the economy?
So when we interpret IIP, we understand there's a lot of seasonality built in the numbers, especially around the months of March and April. So March being the fiscal year end, you usually see, at least on a momentum basis, a very strong month-on-month movement in IIP across, subcomponents. And in April, the very reverse of it happens, that you see a month-on-month momentum correct. And this April reading that we have received is no different. As you pointed out, we have seen a sequential decline in the index number. But I think on a YOY basis, the number has surprised us on the upside. So we were somewhere around 1.4 in our own estimate, and it's considerably surprised, like I said, on the upside. A large part of this upside surprise, I think, has come in from manufacturing, where we see momentum continuing, not just in IIP, but a host of other lead indicators also, not just manufacturing, but in general for economic activity for India, are continuing to paint a very rosy picture. And this momentum, we have spoken about this, was somewhere in place in Q4. We saw the continuation of this momentum with a lot of skepticism whether it will continue into quarter one of FY24. But I think the broad conclusion sitting in the month of June, as we near the end of quarter one of this fiscal year, is that so far we have not seen a very strong or a decisive slowdown in the growth momentum. And you see that across PMI manufacturing services data. PMI manufacturing was at a multi-month high. PMI services, though, it did see a slight deterioration, but again, it was the second highest expansion that we have seen in the last decade or so. If you look at GST, e-way bills, a lot of high frequency indicators are time and again telling us that the momentum in economic activity in India continues to remain strong well into the quarter one of FY24. And we saw that in the GDP numbers, which came in higher than expected, not just for the last quarter, but for the year as a whole. And I think that momentum should continue into quarter one as well. And the IIP reading that we are seeing is just a testimony of that.
All right. Thank you so much for joining us today. That was a great recap of the state of the economy as we see it today.
Thanks, Pallavi.
Stay tuned to BQ Prime.